Hello everyone, welcome back to my YouTube channel. This is the video number 2 to explain the B2B side of the credit risk. B2B means business to business lending, when the bank is offering the loan to all the commercial companies, or commercial lending also is the same name used for this portfolio. Sometimes they call it corporate loans. All of that is something which we are going to cover. And in the previous video, I have explained all the 17 major steps which are used in the B2B lending when the bank is doing that. In today's video, I'm going to show you the SAS code, working SAS code. You will be able to download this SAS code also from the description box, and I will put it in the GitHub repository so that you can download that. I'll make sure. Now, the objective for today is to understand the SAS programming aspect of this when you're building a real life model. But before that, one thing you should remember. In this example, we would be checking that Prestige Group is making Prestige City, for example. So they need 10,000 crore as an investment. They have 3,000 crore in equity, 7,000 crore they are asking bank to pay as a loan. Okay. So basically, in this example, I will be showing you that how bank will be assessing everything for the Prestige Group. But in the real life, Prestige Group will not be the only client. The bank will be giving the loan to Prestige, Godrej, so many other builder, XYZ, small builders also they will be taking the loan. So just like this, there would be profile for each of those corporate company who are taking the loan. Now, before we go ahead, let me try to summarize the steps which I said in the last video. I explained. If you're very first time on the channel, make sure you saw the first video of this one. In the first video, we discussed in detail what are the steps. Today is the video number 2. This video number 2, where I'm going to talk about the SAS code. Now let's quickly talk about the steps involved. There are 17 steps. All of those 70 are part of this. 17 are part of this SAS code. So you will be able to run this also. And we'll create a final proper deep dive output report also, which you will be able to access. Now, this is the SAS University edition, free edition. Okay. So all of you can download this. Now let me make it a little bigger for all of you so that you can understand. So what are the steps? Number 1 would be the deal origination. The process starts when Prestige Group apply for the loan. That is something we would be doing step number 1. Step number 2 would be due diligence. Before considering the loan, the bank verify legal approval, land ownership, environmental clearance, all those things. Then feasibility check will be the third step, where the bank will evaluate whether the project is commercial and it will be having a good viability to get famous. Okay, whether the expected revenue will be able to achieve or not. Then step 4 will talk about financial modeling, like infrastructure lending is future or cash flow based or not. So bank can build financial projection for the whole project for the longer period of time. Then we'll talk about the step 5, credit risk metrics, all those things which are important, DSCR, LLCR and IRR rating, which we discussed in the previous session. Then we'll check the internal credit rating for the customer. Then PD we will calculate. Then next step number 8 would be credit approvals. Step number 9 would be loan structuring, where we'll tell the tenure, proper packaging, interest rate, moratorium period, all those things. Then step number 10 will be consortium. Step number 11 will be loan disbursement. Then we'll go for the construction monitoring. Then we'll go for early warning system. Then we'll go for the ECL calculation, and then profile monitoring, which is known as a model monitoring also in the retail credit risk. Okay, model monitoring is also part of this. Then we'll be going, if the restructuring required, let's say if the bank is under stress, they are not able to, the infrastructure company is under stress and bank is wanting to support the infrastructure company. So what they can do, do some restructuring of the loan. And then in the last, we'll see the default and the recovery. Now that's the whole and soul, all these steps. Now let's go step by step. So step 1 is the deal origination, where I'm creating a data set, project master, and I'm just think from the perspective that one borrower is there. Okay, don't think that we have so many borrower. One borrower is the Prestige. Now borrower and project name, that is something we have defined. Project cost, debt how much we are giving, then equity is 3,000. Project IRR, that is known as internal rate of return. Then industry risk, there is a kind of a segregation or buckets. So this is the medium risk one. It's not something very high risk because it's a prestigious builder. They will be having cash flow good. Then management score on the scale of 1 to 10, because this is one of the top company in construction. So the management score would be also high. This is step number 1. Step number 2 would be due diligence, where you are checking everything, that all the important thing like the approval, clearances from the environment, from the local authority, all those things are yes or no. So you will see that I'm setting the previous data in a new data set. Oops, I think it was open for a long time probably. Let me reopen that. Okay, I think we have the code here, and let me make it big screen now. Let's talk about step number 2 again. So let's go to step number 2. So here we are doing the due diligence. Okay, so we are checking land approval, yes. Legal clearance, yes. Environmental clearance, yes. RERA approval, yes. Due diligence flag, we are setting a new flag, and if anything is no, okay, then due diligence flag is failed. So now let's run step number 1, step 2. I selected it. Just click on this running person and you have the data. So this is the data set. You can see this is a table due diligence. Then you have the project master. So you can see the recent one is this. Project cost, you can see all the variable. Project cost 10,000 crore, then debt 7,000, equity 3,000. All those important variable are part of this. IRR, which we have given right now. Step number 3. So the step number 3, let's go to quickly step number 3. Step number 3 talks about the feasibility assessment. Now in feasibility assessment, we are checking debt to cost ratio. Okay. What is debt to cost ratio? Debt divided by project cost. Then equity ratio, equity divided by project cost. So this was 7,000, this was 3,000. So the expected units of this project, all these detail will be given by the bank that we are making 10,000 units. Expected price is 150K. So now the total expected return would be multiplied this and this. So then you can understand the expected revenue. Now let's see the expected revenue projection is this one. This is the again new data set created. Let's go in the last. Expected revenue is 15,000 crore. So basically they are thinking that out of 10,000 crore investment, they will be able to make at least 15,000 crores. Okay. Now next step is financial modeling. So where they are checking the cash flow, they would be checking the debt to service ratio, they would be checking the future cash flow and the revenue forecast. Okay, all these things. And I said they will be checking the operating cost and EBITDA, which you can see. So the calculation for operating cost is revenue and the multiplier given by the bank team. Okay, then EBITDA is what? Revenue minus operating cost. So you calculate all these things. We run this financial model. Data set will be created. This is financial model. You will see all the values. EBITDA is this much, operating cost is this much. Now we have kind of all the business information about this. So next step is credit risk metrics. So in credit risk metrics, what they are doing? Oops, let me go. Yeah. In credit risk metrics, I am calculating the most important matrices. That is DSCR, LLCR. Now what is DSCR? I explained in the previous video. Okay, so you can see I have given the comment also so that it help you guys to remember. Debt service coverage ratio, then loan life coverage ratio. There are formula for each of them. Okay, annual cash flow and then divided by annual debt service. Okay, so now there is a formula for LLCR. I explained in the previous video, and then PLCR and loan to value. So these are the important concept. All these value will be calculated once I run this. Let's talk about the next step first, then we'll run the code. So internal credit rating you will basically assign the internal credit rating on the basis of various parameter to the company. That what is an internal rating, because this is a very big company. So usually for such cases, the rating will be AAA or AA at least, because if you go for a small builder who's making something very small and they have not much history in the build infrastructure setup and construction company, small construction company, they will give a rating of let's say B or maybe a lesser rating, not A rating for sure. But in this case, it will be A rating. Okay, because this is a big name. Yep. So we have all these ratio already calculated. Then we'll calculate the probability of default. PD will be calculated. So you have the rating. Depending on the rating, the PD multiplier is assigned depending on the rating. Okay. Then credit approval will go. Guys, again, I would mention that this is very simplified way. I'm just giving for one client, but when you have a table where you have thousands of clients, the risk really increase and so many parameter increase. Okay, it's not necessary that credit approval will be having these many line of code only. Once you will be in real time, only credit approval will have 500 line of code also. This whole code is 500. Okay, so just understand the basics. That's the agenda here. Now here you are calculating the credit approval after the PD calculation. So you're using the things that if debt is this big, then approval level would be board credit committee. So let's run till this line. Let's run till that line. So we should be having a clear picture that who's giving the approval. I think it ran, and the data set, let's check the name of the approval model. Approval model is the data set. We were checking this approval model. Let's go to this approval model. In the last, we are seeing PD, but we should be able to see approval level. Why it's not coming? So we have a basic method. Let me check using proc contents data equal to name of this. Proc content basically shows how many variable, how many overall counts, everything about the particular data set. So proc content will show you all that information. Let's run the proc content about this. So it is showing it have 31 variable. Maybe it's not able to accommodate in the output. That's why we are not seeing the approver one. But let me do one thing. So you can see the approver name should be part of this. Yeah, approver level is here, but in the output you cannot see it, right? So if I remove the proc content and I run this, so in this output data, approver name, let me slowly go right. Approver name is not coming probably here. There is a reason I have already understood. Let me show it to you guys. But let me show you before that the approver name is not here. You can see all these variables are passing by, but the approver name is not coming. Now the thing is, I'll just give a proc print, because without proc print, it's only showing limited number of variables, because I'm not printing the data set as of now. This is just the output. Now I will print the data set. So the output, shape, look, appearance, everything will change now. Okay. See, this is very structured. Now at the end, it should be having, yeah, you can see approver level. Okay. Approval level is done. I can remove the proc print. Understood, guys. Okay. Now loan structuring. In the structuring, we are telling that loan amount is this much, loan tenure 15 years, moratorium 3 years, interest rate 10%, security coverage 1.0, 1.5. Okay. 1.50. Then consortium formation, like consortium, you understand. If you have not understood what is consortium, previous video. Okay. You need to watch the previous video. In consortium, what I'm checking, multiple banks are participating. So you can see SBI, ICICI, HDFC, all these banks are participating because it's a big loan. Everybody want to earn money. So that's why they will get it. Okay. So they will come as a business partner, not as a rivals. They want to work together, earn money. Loan disbursement will happen in stages. As I told in the previous video that there will be stages, 500 first, then after a certain milestone, foundation 1000, mid construction 2000, completion disbursement 2500, final disbursement would be 1000. So that way you will get the structure of your loan. You will be getting paid 7000 crores as a company. Then construction monitoring will be there. Complete monitoring will be taking place, and there would be so many people involved in this that time to time the construction levels are getting match or not what they have declared as a bank. So all those things will be getting checked. Like original project cost was, let's say, 10,000 crores. So they will check the actual project cost is going higher than this, because this can happen, right? Because the labor have increased the fees, or maybe the material, raw material cost has increased suddenly because of inflation or any reason. All those things come suddenly, right? So that's why bank always track that what is the actual projection cost at a certain period of time during the whole life cycle of that. It's not like on the day one we said like 10,000 crores, so now this will be done in 10,000 crore. Sometime it will be done in 15,000 crore also. So bank will surely check that, all that. Okay. In this step, the step is construction monitoring. Then EWS will set up a early warning system, which is very important, that if any red flag, so bank will set up, if DSCR is less than this much, at least this much profit I want to earn. DSCR less than 1.20 means at least if I'm investing 1 rupiah, I need to get 1.2 rupiah. Okay. If cost overrun PCT variable, any variable understood, related to the profitability. That's what I mean. Okay. If greater than 20, then EWS, yes. If construction delay more than 12 months, EWS, yes. So this is all these three conditions are actually coming up as an early warning system. Now DSCR should be greater than 1.2. At least on 1 rupiah, I want to make 20 paisa minimum. Otherwise, it's a EWS system. Then we would be calculating ECL, simple formula, PDED, PDEAD, LGD multiplication. Okay, I have said it like several times. So if you're new to the channel, I'll tell you quickly: probability of default, what are the chances the customer will default; EAD, exposure at default, how much money at a particular time is on the stake; LGD is loss given by the default at any point of time. What is the effect? What is the loss this loan will give? That is the LGD. Now the multiplication of these three comes as a expected credit loss. Okay. Then you'll have a portfolio level monitoring where you'll check overall portfolio, the interest, how much collected, principal, how much collected, outstanding balance, how much, including. So obviously bank will recover principal plus interest. So that is something very important for the bank. Okay. Then restructuring if required. If any stress situation comes, then restructuring concept will come. Let's say inflation increased, cement prices increase suddenly now, or COVID kind of situation, restructuring required. Okay. Bank, like the company saying, Prestige Group is saying, let's say we are not able to pay the money at this point of time because of the COVID, all the construction worker have returned to their home. Now bank cannot leave the things, right, for 1 year, 2 year and all that. Bank need to do something. Bank need to do some restructuring. They will increase the tenure. They will give them some discounts. They will give them some free EMIs that you don't need to pay certain EMI or something they need to do. That is all comes under restructuring of the loan. Then if any company default, there will be a module always to check default and recovery. Although these big companies won't default so easily, but you never know. Now this default flag recovery module will be there, and in the last final credit decision we will take. So final lending recommendation generated by the risk team, okay, in any of these banks, all these banks in Bangalore, NCR, Hyderabad and all that. Now there are multiple conditions. If due diligence fail, credit decision fail. If rating is high, EWS flag no, then only approve. Otherwise, it will go to either review, it will either go to reject and reject only. Approve is good rating, no EWS flag. Okay. Now, simply, I would be setting the important variable in proc print so that in the final output, you can see the output and the title will be published on the top of proc print so that all of you understand that. And even your client understand that. Okay. So all these variable, important variable, I explained in the previous video also. Then a proc means what I would be checking the key risk matrices. So these are the key risk matrices, as I said earlier. So then we are just creating a report using proc frequency. We are just checking the final decision, yes or no, because proc frequency check on the basis of two axes by default, X and Y. Okay. Then proc print, simple. And this is the end of the project. Now, if I run this whole code, Control A. And guys, let me again say it to all of you. This is the SAS University edition. Make your profile on this and run your code free of cost. You are able to save your codes in this. Okay. Now, I click anywhere, Control A. Select this running person. So all of you can see the output is here. Okay. Now this output is pretty much self-explanatory, but let me decode the output for you guys. So you can see Prestige City Bangalore heading, approval summary. Now you can see DSCR is 1.5. It's huge. So bank will be investing 1 rupiah and they will be earning 1.5. Okay. That's a good projection. Minimum was 1.2. The rating for the customer is AA. PD is relatively low. LGD is also decent. And this is approved by the board credit committee, which are the higher authority CXO level employees in the bank, the board of director, all of them. Okay. Credit decision is approved. EWS flag, no EWS flag. It's no early warning system in this. And now the output of proc means says all the statistical information you can see. Okay. In the important variable, they are checking mean, minimum value, maximum value, so that you give a proper kind of analysis to this. You understand what is the minimum and maximum values in across your important variable. Then you are checking the output of proc frequency because there is only one decision, approve frequency 100%. Okay. And the overall the portfolio summary, which was articulating and group by basically. So you can see portfolio summary, outstanding balance, interest collected, principal collected, action is normal. Okay. Now, guys, on that note, I would wrap up this video, but make sure you download this SAS code from the GitHub repository. The link will be there in the description. And follow my channel, subscribe to my channel. You guys are not subscribing and you guys are not sharing my video with your friends. I really request all of you to do so. Thank you so much. I'll see you in the next video. All the best, guys.